Welcome to the National Credit Awareness and Resolution Association podcast at ncara.org, NCARA.org, your source for navigating debt repayment challenges during tough economic times. Today we'll explore how small business owners can more effectively use Creditor Tools, specifically loan structuring. NCARA aims to bridge the gap between debtors and creditors as a paradigm shift allows debtors to propose their own repayment solutions. Let's get started. Loan structuring is designed to help ensure a successful borrowing relationship with appropriate measures that serve the debtor's needs in the short and long term and in good and bad economic times. Workout loans may alter the traditional repayment terms and structure, however. Elements of loan structure may include the interest rate pricing and fees, the maturity date, payment amount and frequency, secured or unsecured, lien position, collateral type, guarantors, seasonal funding, loan covenants, financial reporting, and down payment. All these things go into loan structuring. With multiple credit facilities, the creditor should have maturity dates that support the respective loan purposes, along with their own repayment terms. The key for the creditor is to thoroughly understand the debtor and his business, the loan purpose, and the borrowing cause. The creditor will have credit policies and procedures to ensure the loan request is structured to conform to policy requirements, and anything outside of policy is called an exception to policy, which are, by the way, very closely monitored. Most financial institutions are regulated entities, and their underwriting standards, including loan structure, have similar characteristics. Competitive pressures and regulatory changes can affect the elements of loan structure, and loan structure helps ensure that each creditor is lending in a safe and sound manner. So why is all this important to you? Irresponsible swinging back and forth of loan structuring, lack of consistency. Loan structure during economic expansion periods can result in laxed credit underwriting standards. For example, creditors offer light covenants with excessive headroom before the covenant is violated. It's also known as cov light, or non-recourse, limited guarantees, or no guarantors, extended maturities, unsecured or no collateral, crazy low fixed interest rates, and minimal fees. Thank goodness for competition, right? So this happens during your expansion periods in the economy. But you'll see that there's an irresponsible swinging back and forth of loan structuring. For example, during an economic downturn, all bets are off. The creditor is going to get you back to a performing status or take whatever measures he can to make sure your loan is repaid as soon as possible. That is, if you're having financial problems yourself. Interest rates and fees are likely to be increased, rightfully so, right? Higher risk, higher price. Lenders should price for credit risk, and if your loan is subject to higher credit risk, the lender should charge a higher interest rate. This may sound counterintuitive because a disclosable loan modification may result in a lower interest rate. Yes, that is correct. Your workout loan could also result in a not higher, but lower interest rate. It's called, again, a disclosable loan modification. So don't discount out a lower interest rate if that's exactly what you need, which you should ask for. Again, but it's got to be 100% needed. Even though the deal's credit risk is higher and the lender is supposed to be charging you a higher interest rate. But it does not have to be that way. Again, it's called a disclosable loan modification. Overall, the entire structure will become tighter, however, and more controlled by the creditor. This short ad is sponsored by the Debt Crisis Problem podcast. Attention listeners, please join us at tunabudget.com to tune into the Debt Crisis Problem podcast, where in plain English we discuss the 20 risks that could soon fuel a serious economic downturn. We explore critical risks that could trigger these downturns and other practical insights for navigating financial uncertainty. Join us for thought-provoking discussions that encourage transparency and awareness. Subscribe now to stay informed and be ready for whatever comes next. But it's too bad that lenders and borrowers are just not more consistent during these expansionary and recessionary times. You definitely have a much bigger voice in negotiating the loan restructuring process than you realize, both at loan origination and at workout. Yes, it's the creditor's business to know you and your business, but take a close look at the loan structure and step back a minute. Look at it from the lender's perspective and how it might view it thinks how you view it. Who has the stronger negotiation position? If, for example, a guarantor only has a 50% limited guarantee, what does that mean? 50% limited guarantee of what? 50% of a potential loss after the liquidation of assets? Once you know for sure what you're supposed to guarantee, why not negotiate the guarantee amount? Make your case. Your case needs to be reasonable and work within the terms of an acceptable loan structure. It is not as if the patient is telling the doctor what treatment is needed, but if the patient, borrower, is aware of and familiar with treatment options and knows what works best for his needs, why wouldn't he step forward and make a solid recommendation to the doctor or a repayment plan to the creditor, right? Well, like in a new loan, there might be more flexibility in structuring a guarantee, for example. In a workout loan, you pretty much can guarantee that you're going to be 100% responsible for the repayment of the loans. In other words, 100% unlimited guarantee will be in force. But thank you for joining us. Today we covered the Creditor Tool loan structuring as debtors prepare to propose their own repayment solutions. But we want to hear from you. Share your own credit risk memo and debt repayment experiences, questions, and recommendations with us at NACARA.org. If you found today's episode helpful, please subscribe for notifications of future podcasts. Your feedback helps small businesses stay in business. Until next time, step forward and take responsibility for your own debt repayment solutions. Thanks again.